Hey guys, Doug the Retirement Guy here. We have another great review of the YieldMax PYPY Option Income Strategy ETF. That is their PayPal version of their option income. And we're going to ask, is it good for a retirement account? Their dividend yield of 34.96% got our attention for us to heavily look at this. Before we get in the video though, I want to say thanks to each and every one of you. The subscriber counts are just going up. The comments are coming in great. I'm glad you guys are loving this channel, loving what we're doing here. We've added something in the description. Look below, you'll see a Patreon link. If you can help the channel out, great. Any kind of a donation, give us a Coke. Keep the caffeine rolling so that we can go and keep doing these videos. Would be appreciative. Anything helps the channel. Let's get into today's video. The PYPY YieldMax is the PYPL, which is PayPal's option income strategy. So basically, guys, like everything that YieldMax does, they will buy shares of PayPal. They will sell them off on covered calls. They will do that trying to generate as much income as they can from those strategies. Also, we're going to see that they invest a lot into government and treasury bonds and make interest off of that. Their distribution, 34.6%, and a 30-day SEC yield of 4.2 shows some very strong positive numbers. And as I said in the holdings, we look at this. They have a ton of the United States Treasury bonds, and they're all positioned in different percentages of return of interest. And then, of course, right at the bottom, you see that we have a big wide open PayPal purchases accordingly. So very common what we expect to see from these funds. So why PYPY? Well, advertising at 34.96%. I mean, we're always looking for some big returns from some of these accounts. But that 34.96 return is a total over a specific period and includes both your income from dividends, interest, and so on. And some nice big numbers that we can talk about. The 4.2% 30-day SEC yield means there's money coming in. There's money that's going to be flowing into this account in some decent time over a 30-day period. Now, a lot of that, this is what really throws people, is they think this is a great number. But you got to remember, a lot of that is just based off of the interest that's coming in from those treasury notes. They do something that we like here on the channel, and that is the monthly dividend payouts. And like we've always say, we here, reinvestment potential, you get that monthly monthly dividend payment. You can take that, reinvest it back into your stocks, buy more stocks, which would create more income. Or like we do on the channel here, we like that regular cash flow. Bring that money in, pay our bills, and go on with living life. Now, this fund was put together in September of 23. You see a lot of YieldMax programs right in that same period, August and September. So it gives us about a year and a half to give us some good information. Is this a fund that you want to be involved into? And is it producing what we want it to do and what they say it will? So let's take a look at this now in the return section. And right off the bat, warning signs are going off. It's going crazy in our office. And that is 1 month out, they're down 16%. 3 months out, they're down 15%. 6 months out, they're down 0.23%. A little bit of recovery. So like I said, the past 3 months, they have lost their shirt. Year to date, they're down 14.73%. 1 year, though, they're at 25%. So they've had some good seasons, but right now in 2025, they're just losing their shirt. There's no question about it. These numbers don't lie. And since inception, again, a year and a half, they're up 30 points. So what we do is we take our fund, we put our $10,000 investment into it. We go out a year out. So March 5th, 2024, stock price was $18. We were able to invest $10,000 into it for 555 shares of stock. And unfortunately, here we go, all the way back 1 year later, that stock has lost $4 of its share, and it's down 22.14%. So just like the return numbers are showing us, this thing took a nosedive. And really, I looked at it, we were doing really good up to about January, and then it's dropped off again. Now, the dividend side of it was phenomenal because dividends came in at $4,578 or 45.78%. So I was impressed with the dividends that they had coming out of it. So it gives us a total return of 23.64%. So once you take that loss of 22 off of it and tie it in with your dividends, you still got a decent return out of the two. So when we take a look at this, the price adjustment over time, again, we're seeing a lot of this lately, and that is the flat, no pike, there are no peaks, so the drips are big. And it just as I put in the arrows, as you see, this thing started off a little basically right in that $18 price range. And as soon as it takes a drop, you're down to that $15 price range. You have to take a lot of recovery to get back to that 18. And as you can see, the drop off, and we see these in those numbers. We do see where it did drop off and where it regained, and now it dropped back off very heavily. The high point, 19.11. The average price is 17.69. The current price today at 14.02. That's a 20.7% below average. Now, we've talked about this in the past, and we'll say it again here, is the only way that you could be strong into this platform, into this ETF fund, is buying it on sale. Now, if you have a program that's losing 22% of your NAV, and you are now 20% below the average, you're starting to get into the area that I call the buy market, because you're on sale of 20%. So this thing needs, basically, in my eyes, it needs about another 2% to 3% to get to a point where I would say, yes, it's time to get back into it, buy some stock, because the dividend is so high at that 45% that if you buy this right, you're going to be able to get some gains and live on that dividend and keep it accordingly. So I said, we're only about 2% away from something happening in that point. So basically, in our summary, again, over 12 months, you're losing 22% of your value, thumbs down. A dividend gain of 45.78%, I give that thing a thumbs up, and I'll tell you how to operate that. And then when you get to a 12-month return of 23.64%, these are some big numbers here. It's all because that dividend stays where it's at. So you have to be an eagle eye on this thing to watch that the dividend's not going to drop off. That's going to continue to stay paying that. You've got to buy into the stock at the right time, under that 22% discounted level, and to keep your numbers at that 23%. So is PYPY a good for your retirement account? To me, the answer is no. It's got a phenomenal dividend, but your NAV loss is just way, way too high, guys. I would not play around with this fund. Total return of 23.64. Again, too much of your dividend has to go to cover the cost of this. This one here, again, you'd have to do our famous 70-30 split, which is take 70% of the dividends, put it in your pocket. The other 30%, you have to reinvest it back into the stock just to try to cover what you got going on. So again, we put this thing as a hold and don't buy. And to clarify again, so we understand, a 45% dividend rate is so high that the only way I would even look at this thing is if I knew the 45% dividend was coming on a regular basis, and I was able to buy this thing at about a 22 to 24% discount. And then I wouldn't be afraid to get involved into it. We're going to follow this one back around probably about 3 months, just to see if our strategy would be right.